Okay, again, Chapter 8, this is Part 3, and we're going to cover partial year, what happens when you buy it in the middle of the year, change in service life or residual value, and what happens when we get rid of the equipment. All right, partial year. To compute depreciation for partial year, compute depreciation for a full year. So, if purchased on the 1st to the 15th of the month, you count the whole month. Multiplied by fraction of the year, the asset is owned. For example, if an asset is purchased May 1st, you would multiply the annual rate times 8/12. This does not apply to units of production because the actual units are how you allocate. Life is not based on years under units of production. So let's go through our same examples we went through in Part 2. And now we're going to have bought them at a different time of year. So assume in this case we bought it September 17th, which means we don't get to count the month of September. So we would get October, November, December. So we would get the last 3 months of the first year. So it would be 15,000 minus the residual value divided by 4 times 3 months of 12 gives us 750. So this is what's going to happen. The first year is partial, the second, third, and fourth are 100%, and then the last year is going to be the balance, so that the first and last year will always equal 1 year. But so when you have partial year straight line, it drags it out another year, another part of the year. Now, what happens with double declining balance? Well, with double declining balance, again, we're going to take 15,000, take 1 divided by the service life times 2 gives you 50%, and it only affects the first year. Times 3/12 gives you 1875 for our first year. And then for the rest of the years, we always take our net book value times the percentage. And we will keep doing that. Now, again, in year 4, we cannot do 1641 because what that does is takes us below the net book value or residual value that has to be 3,000. So, for year 4, we can only depreciate $281. Now, what happens if we have a change in our useful life? Now, there's a lot of reasons this can happen. It's called a change in estimate. Now, here's what's important. Whenever in accounting we call something a change in estimate, we cannot go back. You cannot go back and change what you did. All you can do is change what you do in the future. So, we have to revise the depreciation formula, and what we always do is at the point we decide we're going to change something, we take the net book value at the time of the change minus whatever the residual value is. If it's a different amount, it's a different amount. Same amount is the same amount divided by the remaining years, and that will give you your new annual depreciation. Again, remember, you cannot go back and change if something is called a change in estimate in accounting. So, in our example, we bought a piece of equipment on January 2018, so we get the whole year with an estimated service life of 4 years, residual value of 2, and estimated 800 operations over its service life. And then we tell the actual. What is the depreciation expense under the 3 methods, assuming that in year 3 they switch to straight line? While using straight line, it wouldn't be any different because we would have been doing that all along. But what about units of production? Well, first of all, we have to figure out how much we've written off so far. So we would first calculate, we would take our estimated usage of 800 and divide that into our depreciable base of 36, and we get $45 per operation. And then we look at how much we allocated in year 1 and 2, which gives us our accumulated depreciation. We now look at what our net book value is, which is the original amount we paid of $38,000 minus our $15,300, which gives us a net book value of $22,700. We take away our estimated salvage value. We have our new depreciable base divided by remaining years, so we will be writing off $10,350 for year 3 and 4 because we use straight line depreciation is the same every year. What about double declining balance? Well, we're going to come up with our rate times 2. Year 1, it would be 50% of 38,000. Year 2, it would be 38 minus 19 to get our net book value times 50%. That gives us our total accumulated depreciation. Now we determine our net book value, which is $9,500. And to get the straight line, we're going to take the $9,500 minus our residual value divided by 2, which tells us for the next 2 years, we're going to write off $3,750. Now let's look at another example. We have a company, they acquired a piece of equipment. They had an estimated useful life of 10 years and an estimated salvage value of 25. 3 years later, let's see, 2019, 2020, 2020. Yeah, 3 years later, they decided that the equipment really only has an 8-year life and it has an estimated salvage value of $20,000. So first we got to look at what's the net book value. We know what the cost of the equipment is. We have to then determine the depreciation for 3 years using straight line. We now know what the net book value is. We subtract the new residual value. We have our new depreciable base. We divide that by the remaining years, and now the annual depreciation is going to be $42,300. Now, how do we account for repairs? Well, here's how it works. If they're ordinary repairs, they're treated as an expense. So they're on the income statement. If they extraordinary repairs, i.e., they make the equipment produce more units or generate more revenue, then we can capitalize it. Now, what happens if we discard, sell, or exchange for another asset, a fixed asset? Here's what you need to remember. Record what you got, record what you gave up. Now, record what you got would be the new equipment or cash if you sold it. What did you give up? Well, you have to take the equipment off the book, but remember, you also have to take the accumulated depreciation off the books. And your debits must equal your credits, and that's how you determine if you had a gain or loss. So, for example, what happens if a lighting company bought fixtures for $18,000, service life of 8 years, and after a year and 8 months, they decide to sell them, and they sold them for $13,200. So what was the annual depreciation? Was $22,500. How long did this go on? Well, a year and 8 months. So 1 year is $22,500. 8 months is $1,500. So there's the accumulated depreciation. Now, here's what you need to do when you do your journal. First thing you want to do is record the cash. Next, you want to get your accumulated depreciation off the books, which is the $3,750, and you have to debit it because accumulated depreciation's normal balance is a credit. You want to take the old equipment off the books. Then what you're going to do is you add your debits, add your credits. If you debit it, it's a loss. If you credit it, it's a gain. So in this case, to get it to equal $18,000, we have a loss on sale of equipment. Now, what if the equipment is exchanged for newer equipment? Okay, Maple Trucking uses units of production, and in 2019 bought a truck, useful life of 6 years. Estimated usage over its life is $1,500,000, and estimated residual value is $85,000. We use the truck, and then we decided to trade it in. So now what we have to do, remember, whenever we do this, the first thing we need to figure out is what is the net book value. So to do that, we need to determine the accumulated depreciation. So the total miles to date were, first we got to figure out our depreciation per unit, which was our $385, the cost, minus the residual value divided by the estimated total units. So we get 20 cents. Then our total miles, 761,000. We're going to take that times the 20 cents, so that tells us our accumulated depreciation is $152,200. Now, what we want to do first, whenever we do anything that gets rid of, we want to take the old equipment off the books. So we take the accumulated depreciation off the books for the old equipment. We take the equipment off the books. Then we book the cash. Then we book the value of our new equipment. This equals 574, so that means in this case, because we have to credit it, we have a gain on exchange of $10,200. And now if you notice, so remember your debits have to always equal your credits when you do these. Now, amortization is the process of allocating the cost of an intangible asset. Amortization is computed over the intangible asset's estimated useful life, usually by straight lining. The residual value is usually 0. Obsolescence can shorten the life, like an example is a patent becomes obscure. Amortization expense is credited directly to the asset account. So you don't have a contra account with amortization. It reduces the actual amount shown as the value of the asset. Examples would be patents, copyrights, trademarks, brand names, goodwill, franchise, and licenses. The last thing we talk about is natural resources. Natural resources are assets that come from the earth. The process of allocating the cost of a natural resource to an expense is called depletion. Depletion expense what is used up each period. And that concludes this part 3 presentation.